Darius, welcome to the show.
Hey, Julie, what's up? How are you?
I'm really excited to talk to you. It's like something I'm like, oh my gosh, it's something I've always wanted to do. So,
I appreciate that.
Yeah, I get to watch your
Before we even
commentary.
get going, I think you need to tell Joe and John that we're currently running at an all-time high in the employment cost index. That's the broadest measure of wage inflation. So they might need to have a talk with their brother.
Oh, they've been trying to unionize. I don't know if you've heard about that. But
unionize?
Yeah, I don't want to be in their union.
But...
They're mad at me now.
Oh my God.
Definitely will. All right. So we're closing out the quarter. We're closing out the first half of the year. Obviously, like markets have just been in a steep decline. Worst for the S&P or close at the worst since 1970. So it's been a long time. I would just love to start with like more of like your big picture of where we are in the markets and maybe your outlook ahead.
Yeah, absolutely. So, for those who have been paying attention to the show, it's pretty straightforward. So I'll summarize everything. At 42 Macro, we believe that if you use enough data, use enough math, have enough of a repeatable process, you can sort of harness these sort of big macro cycles that tend to drive dispersion within and across asset markets, and obviously take advantage of that from a portfolio perspective. There's sort of, we consider there to be four big cycles. There's the liquidity cycle. So as if you think about the Fed balance sheet or interest rates, is that getting more positive, more favorable for asset markets or less favorable? Clearly, we're in a liquidity cycle downturn. Our views is we're close to, let's call it inning 5 or 6 on that. For those of you who are not Americans, baseball is played in 9 innings. So we're probably, let's call it 2/3 the way done in terms of liquidity cycle downturn. As it relates to the growth cycle, which is another important cycle, we're probably in inning 4 or 5 in the growth cycle downturn. It's set to significantly deepen in the coming months, at least according to our forecast. We're probably in extra innings in the inflation cycle upturn, as evidenced by the most recent headline PCE and headline CPI or CPI reports that we've gotten in recent weeks. And then lastly, I think we're probably close to inning 1 or 2 of the profits cycle downturn. What I mean by profits, we're talking about corporate profits, corporate earnings, the things that will drive, incremental decisions, going back to your previous discussion about, whether or not companies are spending more money on marketing, more money on hiring, et cetera. So we are not in a favorable place to be speculating on the long side of most risk assets as a function of those 4 downturns.
So there's a lot of talk right now about, are we in a recession? We'll obviously find out when we get this second quarter GDP print, but what is kind of your thought process there? And like, how do you kind of think about that?
Yeah, so I sent you guys some charts. Are you able to put them up?
Yeah, we can pull the charts up. Which one would you like us to pull up? Maybe the
first one. So model implied probability.
Yeah, let's pull up the model implied probabilities chart if we can.
Yeah, so this first. So what we're trying to do with these charts is identify whether or not we are in recession or likely headed to a recession over the medium term in some investable time horizon. Anything over a year is generally not investable from a risk management perspective. There can be, you can talk about stuff a year from now, but it's not going to really matter to markets. So what I'm showing in this top chart, the blue line in the upper panel just shows the New York Fed. That's the Federal Reserve Bank of New York's recession implied probability model down at 4%, 4% probability of having a recession over the next 12 months. One, I think that number's wrong, but 2, it's significantly lower than where it's typically at on a mean basis. Heading into recession, that number is around 27%. So typically right into a new, recession, that number's on average around 27%. So it tells you a couple things. It tells you, one, at the onset of recession, even the recession probabilities are still generally low. So you need to have forward-looking indicators to give you a better view on that. And then number 2, the red line in the upper panel just shows the model I put together just based on a couple of Bloomberg models that are anchoring on the 10s-2s Treasury yield curve and the 10-year 3-month Treasury yield curve. That recession probability is currently around 25%. Historically, it's been on average around 35% at the onset of recession. So that's much closer to signaling, hey, look, we might actually be in recession. But to me, I think the discussion around recession is really coming from the consumer. The second chart I sent you is consumer confidence.
Yeah, we can pull that up too.
Yeah, absolutely. So the chart, the top upper panel in that chart shows the blue line just shows Conference Board's consumer confidence measure. That's sort of one of the more stickier autocorrelated consumer confidence measures that we have. It tends to be more correlated to the labor cycle than the University of Michigan survey, which is also widely followed. That tends to be more correlated to inflation. But the key takeaway on this chart is that historically, when you've seen consumer confidence break down below its trailing 3-year average, you're typically in or just about heading into recession. And very clearly, with the most recent data point we got yesterday, I want to say yesterday or 2 days ago, 99. I think we're now careening well south of the trailing 3-year average, which takes me to my final chart, consumer expectations. This other chart, consumer expectations, sort of breaks into a couple of different indices within that consumer confidence report. Again, these are June data points, so they're pretty relevant, they're pretty fresh. The red line in the top panel just shows the present situation index within that conference board consumer confidence report. The blue line shows the expectations index. So how do consumers think about what's likely to happen over the medium term? And as you can see, there's this massive divergence between how consumers think the economy is today, how they feel about the economy today relative to where they think the economy is going to be in the future. That's denoted by the spread there down at the bottom panel. Now that spread at minus 80, 90 basis points wide to the negative side is about as deeply negative as it's ever been. It's in the first percentile all the monthly readings since going back to the late 60s when these indicators were born. So that tells you that, as you can see where those red bars are in the chart, historically speaking, when you get to a very deeply negative spread between consumers' expectations and how they currently feel about the economy, you typically are walking into a recession, because that's typically how it happens, right? You start feeling bad about the future, and therefore you adjust your current spending, your current expenditures, et cetera, to how you feel. And this is all part of the behavioral dynamic associated with, economies and financial markets called prospect theory. We don't need to get into that now. Definitely go check out Danny Kahneman's book, Thinking Fast and Slow, if you want more details on that.
I like that. And it's like the psychology of it. I guess like a follow on to that, because like I'm looking at your models, like, is there a way to like assess, how severe a recession might be, like when you're looking at these indicators? Like, how do you kind of think about, like, is it like something that's quick? And I would love to explore that with you.
Yeah, so that's a great question, Julie. So there's a couple of ways to do that on an ex ante basis. One, you could sort of, the easiest way to do that is try to understand kind of the different leverage cycle dynamics. The first would be, how fast has credit grown into the downturn? Historically speaking, whenever you see a significant positive deviation in the credit to GDP metric, particularly private non-financial sector credit to GDP into a downturn, that's what we saw in 2007. You typically get a more deeper, nastier kind of asset price-led recession that takes longer to recover from. A second way to explore that on an ex ante basis is looking at looking to observe if you have a positive deviation, a significantly positive deviation from the trend in what we call the debt service ratio. So that's the total amount of sort of interest payments and amortization or paying back debt, for the broader private non-financial sector. And currently speaking, neither of those two indicators are signaling kind of cause for significant alarm, i.e. neither are suggesting that we're likely to have a deep, lasting, prolonged, protracted recession, which is a good thing. Now, the one thing I'll caveat this by saying, the data that, we get this, we derive those statistics from are released on a pretty severe lag. So we're talking about Q4 21 statistics, and it's obviously the end of the second quarter of 2022. So fast forward 6 months from now, we could be getting statistics for the second quarter of this year that may say otherwise. But for now, just being data driven, we can understand that any recession we are likely to experience over the next 12 months or so should be shallow. In my opinion, I think it's more likely to resemble the 2001 recession, which was, you need a magnifying glass to, kind of really see it on the map. It was the shallowest recession in U.S. economic history at peak to trough decline and output of minus 70 basis points. But guess what? That didn't matter to the market. S&P was cut in half. NASDAQ was down 80% in the span of that, 2.5-year bear market. So you have to be careful not to associate your expected outcomes in financial market terms with your expected outcomes in economic terms. The destination doesn't have to be the same, but the rate of change is likely to sort of perpetuate and feed upon each other.
That's interesting. You say that didn't matter to the market. Like, also just kind of makes me wonder. Like, say we find out we get the Q2 GDP number, and it's like, okay, like you have 2 consecutive quarters of negative GDP growth. Like, do you think the market's kind of priced in that scenario, or like, is there further to go here? What do you think?
Yeah, great question. Great question. So I'll start by, there's 2 things to unpack there. I'll start with the first part of your question, which is the 2 consecutive quarters of negative GDP. That would constitute a technical recession by the letter of the law. 2 consecutive quarters of contraction is a technical recession. that will not constitute an actual recession by the sort of market and by the Federal Reserve, and certainly by the people who determine whether or not the economy's been in recession, which is the NBER. Their definition is more along the lines of my definition of recession, which is a statistically significant deviation, negative deviation from the trend in output. You can measure output obviously through GDP, industrial production, consumer spending, consumer income, total employment. All those things tend to be correlated to the downside and a significant deviation from their respective trends. We have not seen that yet. However, when you go back and you think about it from a technical recession standpoint, we are certainly developing that one. I mean, we got the PCE data, the personal consumptions expenditure data point for the month of May this morning, and it was pretty bad. It was very bad, actually. We talked about that in our Macro Minute program. Check out our YouTube channel, by the way, for those of you who don't pay attention to those. But anyway, so on a headline basis, so aggregate consumer spending in the economy, which is 2/3 of overall GDP, slowed to 0.2% on a 3-month annualized basis through the month of May. And so if we stay around these levels, or if it gets any worse for the month of June, we will have negative consumption growth on a 3-month annualized basis, on a quarter-over-quarter basis in the second quarter. That's being dragged down by goods consumption, which is down 1.4% on a 3-month annualized basis. Services consumption is up at 1%, but guess what? 1% ain't going to cut it. One, that's half the trend growth rate. And number two, we're supposed to be in the middle of a services sector boom, right? I mean, how many stories have we heard about, the pandemic being over, getting on airplanes, we're going on vacation, we're going out to eat, we're going to the theater, et cetera, et cetera. And guess what? All that narrative adds up to a mere 1 percentage point growth rate in 3-month annualized terms for services consumption. So, we continue to see consumers get squeezed from a real income perspective. Real incomes have been basically trending at down 4% year over year for the last year on either a aggregate or a per capita basis. And so, in our opinion, the data is starting to get nasty enough to start pondering the question, are we currently in recession, or are we, getting close to entering one? And I think the jury, the sort of, the answer to that question certainly moved in the direction of recession very much in the last kind of 2 to 3 hours.
I think that's why I love listening to you, because I feel like I always learn things too. And you point out, there's been that narrative of oh, it's a services boom. But as you point out, probably not the case as it turns out. I want to ask you about inflation too. Like you mentioned, we got the PCE this morning. It was bad. And I know that's a gauge that the Fed does look at. Like, how do you think about inflation? Like, is it systemic? Is it abating? Like, I just wonder how you kind of begin to assess that.
Yeah, so inflation is very much systemic. There's several ways we can assess that, not the least of which is the data we got from this morning's report. We saw an acceleration in headline PCE inflation on both the 3-month annualized and year-over-year rate of change terms. So that was a problem. We saw a re-acceleration in 3-month annualized terms in core PCE, which is the Fed's preferred inflation metric, at 4.1%. It's basically a double of where the Fed needs it to be. So that's a problem from the liquidity perspective of the liquidity cycle. But to answer your question specifically on, is inflation systemic? The answer is unequivocally yes. The Cleveland Fed has an index called median CPI, which measures the median rate of change in inflation terms for everything in the inflation basket. There's hundreds, of indicators in the inflation basket. And what we're seeing on a median basis, not on a weighted basis, on a median basis, inflation accelerate to new all-time highs. 5.5% on a year-over-year basis, that's a new all-time high in May. 6.4% on a 3-month annualized basis, that's a new all-time high for that time series. So to answer your question, yes, we are very much in a systemic, broadening inflation shock that ultimately we think the Fed is going to stick to its guns and do something about.
Mm-hmm. Let's talk about the Fed and sticking to its guns. Jay Powell, we had comments from Jay Powell this week. We also heard from Christine Lagarde. We heard from BOE's Andrew Bailey. Just kind of would love to hear your reaction from what we're hearing from central banks as it relates to some of these issues.
Yeah, so I thought Jay Powell, so was that yesterday, Wednesday, at the ECB forum, Jay Powell really stood out to me, one in his tone, but also he made a very important direct comment to financial market participants and investors, to everyone in the economy. And it was very basic. Look, we are going to do whatever it takes to get inflation back to our 2% target. That process will involve some pain, but that will be less of a pain than just not achieving our objective, right? So he's basically saying if we allow inflation to stick around here, more people, particularly people on the low end of the income spectrum, are going to get, they already feel like it's a recession for them already, by the way. Some 10 to 20, 30% of the economy is already in recession just as a function of their income level. And so what he's effectively saying is, look, it's going to be bad no matter what. And right now, if we allow inflation to continue to fester, it's going to be bad for the largest number of people for the longest period of time, as opposed to just going, tightening us into a significant enough slowdown in output to get us to a more balanced supply and demand spectrum that will ultimately give us better outcomes on the inflation front. So I thought that was about as direct as I've ever heard a central banker talk. Usually, sorry, I take that back, in hawkish terms. Yeah. When they talk, usually they're very direct when they're talking about stimulating, right? Because they want to prevent deflation. They want asset markets to go up. They want to revive animal spirits. It's very rare that these people talk so directly and frankly when they're actually trying to, for lack of a better term, beat asset markets with a wooden stick. Yeah. I've been making this joke that Powell's got this aluminum bat. He's like a 12-year-old at a birthday party with the aluminum bat, taking it to the piñata, and he doesn't even have a blindfold on. So he's just beating the crap out of the piñata. And until this dang thing breaks, i.e. inflation, he's going to keep beating the piñata.
Yeah, all the candy is going to be the inflation. That's an interesting visual. You just mentioned like him being direct, like just as a market participant, someone who's been in this business for a while. Like, I mean, I imagine like your peer group also was feeling similar things. Like, you probably want him to be more direct, I'd imagine. Like, do you think that that's the kind of Powell we're going to get going forward?
Yeah, I mean, so and sort of dating myself, I found out today I have a bald spot on my head. Oh my goodness. I didn't know that. So I guess I have been in this industry for a while. I've been in it for a while too. But so that's neither here nor there. But yeah, so the answer is yes. This is a Federal Reserve. Don't forget, I made this comment on this program many times for the last 6-9 months, that this is a Federal Reserve that is fighting two wars, not one war. It's not just inflation. They're fighting the war of credibility as well, right? Like they spent all of last year aggressively easing, aggressively expanding their balance sheet to the tune of $120 billion of QE per month as inflation was continuing to fester with this sort of narrative that it was going to be transitory. One of the worst calls in financial market history, let alone one of the worst calls for the central bank. So now they're fighting to regain the credibility associated with getting the inflation call so wrong, that call that was so wrong that is currently roiling, sort of the budgets of so many millions of American households right now. If you, everybody watching, many of the people watching this show, inflation is it's nuisance for a lot of us. It's not I grew up very poor. It's not a nuisance when you're poor. It is a life-altering event. You have to stop consuming. You trade down, even though you're already at the low end of the trade down spectrum. I mean, if you're buying bagged cereal because you can't afford box cereal, now you're no longer buying cereal. That's what 8.6% inflation does in this country. I'm not sure that everyone understands that.
It's a really important point that you bring up, like how it affects like lower income American. You just gave that example. Like, let's explore that further. What could be some of the broader consequences of that? Like, what could that mean for like maybe even like the social fabric of our country?
So, I mean, as you can see, it's being clearly reflected in Joe Biden's approval rating, on the broader approval rating of Congress. Obviously there's a lot going on down there. So let's, I don't want to get too far into that, but, it's clearly an issue. I mean, this is the key takeaway. And it's somebody, I'm going to misquote or misassign the quote, but it was one of the most one of the most interesting things I heard about inflation all year. And I apologize for who I'm still in school from. I'll remind everyone next Thursday. But they said, and I thought I agreed with it, and I realized, oh my God, this is what Powell thinks. And the quote is, when you go into recession, the unemployment rate backs up 2, 3, 4 at worst, 400 or 500 basis points. So that's, that percentage of people in an economy are going to have that hard time. When you have a significant inflation shock, 100% of the American citizens are dealing with it right now. So we're talking about, a recession being this big boogeyman that may only impact, significantly impact, let's call it 3 to 5% of the economy, as opposed to this inflation, which is currently impacting, skimming off the top of rich people who don't even notice, at least 90% of the economy. So I think that's the battle they're fighting. And to me, it's a much more common sense battle.
Yeah. Let's see. I'm trying to think let's kind of pivot a little bit and just bring up some other topics, just because I think it's interesting. Like, I like at the top of this, you go over like the indicators that you pay attention to. What are kind of maybe more of the underrated signals that you look to or pay attention to that could be helpful for folks watching?
So, I mean, anybody who's subscribed to our work, seen my work over the years or my career, there's not we look at everything. I mean, if there's a statistic that matters to financial markets or that matters to predicting GDP, to predicting CPI, to predicting, eventually inflections in the liquidity cycle, then we're analyzing it. I mean, our nowcast models have thousands of data points in them from a fundamental standpoint. Our market regime model has 1,048 data points in it on a daily basis to identify what market regime we're in. These are, we run serious models at 42 macro. So I don't want to give your listeners the sort of the sense that, oh, there's one or two things you can look at to do this at a high level, because there's not. It's a full-time job to be average at this industry, average at what we're trying to get accomplished here. And knock on wood, we've been a lot better than the average this year.
Totally. Fair enough. And then also kind of going back to when you were showing the models, like how when you had your first chart, how the one was kind of like totally off, like what are they missing though in the model? Like what is it that's not in there?
Well, so right now you have a pretty, the number one thing that will tell you that we're unlikely to be in, two things that'll tell you we're unlikely to be in a recession right now is corporate profitability. Historically speaking, you've seen sort of a significant decline in corporate profitability during recession. So on a trailing 12-month basis, that is very much not the case. We have some pretty robust earnings growth on a look back basis. And then second, the yield curve that is typically associated with, timing recessions, which is the 10-year, 3-month Treasury yield curve, that continues to be very positively sloped. Very wide yield curve, very wide, wide yield curve on that measure. So that continues to tell investors that, hey, look, if we are going to recession, it's a ways away. It's a year away at best, if not, maybe even 2 years away as a function of that. But, I have the belief that if you get into a significant slowdown in growth, which is what our models are forecasting for, really the better part of the third quarter and really into the early part of next year, once we start to observe the economic statistics associated with that significant decline in output, then you're very much likely to start to see a rally in long end of the Treasury curve while the Fed is continuing to hike. And that's how you can eventually get that inversion, perhaps by the end of the year.
Okay. How about in terms of, I'm just thinking back to from the beginning of our conversation, that I guess I wrote down a couple notes here, but anything over a year not being investable, when you're kind of going over like the big cycles that we're in, from an investment.
Well, it's not that it's not investable. It's just the market won't give a damn.
Yeah.
When you talk about the market's response to the growth cycle, the inflation cycle, the profit cycle, and most importantly, the liquidity we've backtested this as well as anyone I've seen. I mean, certainly we don't have the opportunity to look at everyone's buy side process, but certainly I can observe what's happening on the sell side. And I think we have some of the best backtests in the world. And our backtests show that once you get beyond 3 months, in terms of, a look forward, markets don't really have any response to those kinds of dynamics, right? And so if you're talking about like liquidity cycle, growth cycle, Powell, inflation growth having an impact on asset markets, it's usually within the next few months that the market is trying to, fill around and price in. It's not the next 2 to 3 years. That stuff will happen along the way. The catalysts are, drive you higher or drive you lower along the way.
That's a good point. Yeah, it's happening, I guess, much more, closer to where we are than further out. I do want to just ask, like, maybe from an investment perspective, like, I don't know if you could share, like where would you want to be like right now? Like,
yeah, I mean, so, out of respect for our paying subscribers, and we're very appreciative of them, I'm not going to give too specific of advice, but one thing I'll say, just something I've been saying in the program all year, which is cash is king in an environment like this. You don't need, when you're in a simultaneous liquidity cycle downturn, growth cycle downturn, and profit cycle downturn, few things in the history of asset markets are as negative for risk assets as those things being, in that state, in that condition all at the same time. And so, if you came into the year looking backwards, we were in a growth cycle upturn, liquidity cycle upturn, everything. It was the liquidity bonanza. I mean, it wasn't an upturn, it was a bonanza. Some of the most aggressive easing we've ever seen out of the Federal Reserve in the history of that institution. So it was, if you were, whatever risk you were running, whatever, capital at risk you were running in that environment, it needs to be significantly curtailed to risk manage this environment. I mean, just have less risk on is the number one, the answer to your question. Then obviously, which is a call we made going back to November of last year, the higher beta, the more volatile, the things that go up the most when the market's going up the most tend to go down the most when the market's going down. And so we made a call that, hey, if you have a lot of high beta assets in your portfolio, you need to get rid of them because the market is going to sell them. And ultimately, obviously, it continues to sell them to this day.
Yeah. I want to bring it up with you just because of like, the makeup of our audience is just like kind of your views on, I don't know what your latest is on Bitcoin. I'm just looking at the price right now. It's just under 19,000. So it's 18,930 and some change right now. What are your views? I think it's on track. It's going to be I want to say it's like worst month, at least in a long time. So
worst quarter since 2011.
There you go. See?
Yeah. Yeah. So Bitcoin, I'm concerned. I don't want to scare. I know this is a Bitcoin friendly program. I myself am a Bitcoiner. But I'm definitely concerned. And here's why. We made a call going back to April that we thought the support for Bitcoin, where you would back the truck up and buy it, was 19,000. I am shocked that we are here so fast. I am absolutely shocked that we have gotten down here so quickly. And that tells me that if 19,000 doesn't hold, I don't know, pick a round number, 15,000, 10,000. I don't know. There is no support once you break 19,000, at least not in terms of our analysis. And so, we talk about this liquidity cycle downturn. Let's not forget that we're only doing about half the total amount of quantitative tightening that the Fed intends to initiate, over the course of the medium term. So by September, we're going to double the pace of quantitative tightening from draining 45 billion of liquidity out of the market, for lack of a better phrase, to 95 billion. That's as fast as the Fed has ever drained liquidity from the market by a double. And so my point that I'm bringing up is that when you factor that in, you factor in the overcapitalization of the Treasury as a function of, the T-bill shortage as a result of that, and ultimately the rapidly rising uptake in the Fed's reverse repo facility balance, all these dynamics are sort of combining to drain massive amounts of liquidity from financial markets. And so if you do the math on our analysis, we get to about, basically, just shy of $1 trillion of liquidity is going to get drained from financial markets between now and year end if the Fed stays on this course and if the dynamics with the reverse repo facility don't materially change. If that happens, fair value on the S&P 500 is 2,900. So guess where Bitcoin is going to be on a correlation weighted basis if the market declines significantly from here?
I'm just looking right now. You said $1 trillion?
It's 915 billion to be exact. So. Sorry.
That's okay. Okay. I guess like the quick following question too, like when you talk about the liquidity cycle downturn, you said at the top of this program, we're in the 5th or 6th inning. Does it accelerate over time? Does it get like, as you go through that cycle, like how does that play out? Is it like a smooth thing, or does it just like spiral and get worse and worse as you get further in the cycle?
I'd love for it to be smooth, but the reality is I wake up at 4:30 in the morning every day because it's not smooth. It's nonlinear. Markets are, they're dynamic ecosystems. And so the reality is, one acceleration in one factor can lead to a deceleration in another factor and vice versa. One thing we know we're going to get is we're very likely to get a reduction in the size of rate increases, particularly after we get past this July 27th FOMC meeting. I'm not so sure we're going to get another 75 basis point rate hike. I mean, maybe it's 75, but I think, by the time we get there, it could be 50 if we get a couple of decent inflation prints. We get June CPI on the 13th. Maybe we get some significant decline in crude oil into the summertime, potentially. I don't know. I'm not making that call. That could cause the Fed to go to 50 in July 27. But the reality is, we're not going to stick at 75. That's unlikely. So, we're going to see a slowdown in the pace of rate hikes. But we're at the same time, we're going to get an acceleration in the quantitative tightening program. So, on net, generally speaking, quantitative tightening has a more of a near-term sort of coincident impact on asset markets, QE and QT, than interest rate hikes and interest rate cuts.
Mm-hmm. Just like you mentioned the inflation print. Do you have like kind of a number in mind? Like I don't know if we actually mentioned a specific number, but what are you kind of thinking there?
For headline CPI, we are at. Trying to pull up our estimates now. We're sticking at 8.6 for June. Okay. For June. Yeah. So that number will be out on July 13th.
Gotcha. Any parting thoughts before I let you go?
Yeah. This is not the time to be cavalier. I know a lot of folks have probably this first half of the year has not gone the way they probably hoped, and that's okay. Not everything in life is going to go the way you hope, but the most important, thing you need to make is you need to make a decision determination on what is your next play. Sometimes you give up a sack, sometimes you give up a touchdown, but at the end of the day, the game is not over. You have to make a decision on how to regroup, reallocate your focus budget so that you can take advantage of the next series of opportunities and catalysts in markets. And if you don't know what those opportunities and catalysts are, then come check us out at 42 Macro. If not, just catch you back here next week.
I love that. Well, I was going to ask you, where can folks find you online? So you mentioned 42 Macro. Let folks know where they can find you and learn more.
Yeah, so come check us out at 42macro.com if you're a serious investor. And what I mean by serious investor is someone who has legitimate investment objectives, serious size in terms of their asset allocation, in terms of their capital risk. You can be professional, you can be non-professional, both obviously as subscribers. And obviously if you're either a non-serious investor, someone who can't afford it, college student, et cetera, then come follow us on Twitter. We put out a lot of research on our YouTube channel as well. So, we definitely have something for everybody, but I definitely think this is the time where if you don't have a legitimate macro process heading into the second half of this year, you will struggle. That's a guarantee.
Yeah. They can also find you on Twitter as well. We just showed your handle.
42 Macro details, my handle.
Amazing. Well, Darius Dale, founder and CEO of 42 Macro, I thank you so much for your time and your fascinating discussion, and just also the way you end things with like those parting words of wisdom for everyone. It really puts things in perspective. So thanks again.
Of course, Julia. Look forward to next time. Cheers.